Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
As India turns 71, the rupee has hit 70 against the dollar for the first time ever, the rupee breaching the psychological mark, but it did manage to reverse the losses by the end of the trading day. The rupee was at 61 to the dollar when Prime Minister Narendra Modi made his first Independence Day speech from the ramparts of the Red Fort in 2014. Now we're at 70. So does a weaker rupee point to a sluggish macro? The data is throwing up a mixed picture. On one hand, inflation is on the mend, at least if you go by the consumer price index in July, just over 4%, the lowest that we've seen in the last 9 months. This is also just above the Reserve Bank's stated goal of 4%. But with crude prices staying at elevated levels, the twin deficit problem could be rearing its head once again. The trade deficit now at over $16 billion, the highest that we've seen in 5 years. Current account deficit is also moving higher, with some estimating that it could touch 2.5% of GDP by the end of the financial year. And as the general elections draw near, there are fears that the government may go into overdrive on expenditure and throw caution to the winds on the fiscal front, though the Finance Minister, Piyush Goyal, as well as Arun Jaitley, the Union Minister, have categorically stated that the government intends to stick to the path of fiscal prudence. So as we celebrate 71 years of independence, is the economy on the right track? To discuss that and more, we've got with us Sajid Chinoy of JP Morgan, Rakesh Mohan, the former Deputy Governor of the Reserve Bank, and Pranab Sen, former Principal Advisor of Planning Commission, also with us. Gentlemen, appreciate you joining us. Mr. Mohan, let me start by asking you, because the headlines being captured by the rupee, do you believe that the rupee's weakness is likely to persist or in fact be aggravated? And what are the domestic risks that you see as far as a weakening rupee is concerned? The external risks perhaps have been clearly articulated because of what we're seeing happen with emerging markets, with the monetary policy accommodation of developing markets, developed markets now starting to be withdrawn. We've seen the impact on emerging market currencies like the lira. What's the external risk and what's the domestic risk when it comes to the rupee?
Well, I think that we are coming to somewhat difficult time for macro management in the country. You've laid out all the parameters very well. I'm glad that Sajid is on the panel, because he in fact done some very careful work recently on the evolution of India's trade balance, current account deficit, etc. So let me say the first point is that until recently, until a couple of months back, the rupee had really been, the nominal rupee value had been excessively stable for too long a time, with the result that the real exchange rates had appreciated quite significantly in the last 4 years or so. And partly as a consequence of that, we've seen very significant export sluggishness relative to the past performance of Indian exports, and also during a time when global trade has been recovering after, of course, a slump after North Atlantic financial crisis. So in a sense, the current downward trend of the nominal value of the rupee is actually, in my view, a very welcome trend. Having said that, I think that the Reserve Bank and the government will have to do very careful management, and they really will have to be on the same page with a great degree of cooperation and joint management. You talked about the external dangers. You already mentioned that the monetary accommodation is being withdrawn in advanced economies. So that's obviously going to have an impact on foreign inflows of capital. Second, and this I think is something very important, we really need to watch the Turkey crisis very carefully, because apart from the sort of currency impact that we've seen in the last couple of days in Turkey, there are some other associated fallouts that will have to be watched. Turkey already has more than 3 million migrants from Syria because of the war in Syria. Given that the Syrian government forces are closing in on the rebels, there could be greater pressures on Turkey. And given that they're having this currency and economic crisis, their capacity to absorb such migrants would be much lower, and also other pressures being put on them by the United States. So the point of that is that there could be pressures on European countries from fresh waves of migration from Turkey, which could again cause some more geopolitical disturbances. So there are a number of other things that I could say on this, but the general point is that, if I can just summarize, one, that the currency depreciation taking place today is very welcome. However, we need to manage the orderliness in the depreciation that takes place. By various calculations, the real exchange rate had indeed appreciated about 20% between 2014 and early 2018. Sajid has clearer numbers on this, which I hope he'll give. And therefore, this is welcome news. But given the international developments that are taking place, both in terms of monetary policy and advanced economies, also certain geopolitical developments, plus the trade wars that are being mounted, that this is going to be a very, a very fragile time internationally.
Challenging environment.
And we'll have to use all our wits, both from the government and the Reserve Bank, to manage it. And finally, what you also mentioned, that this being the pre-election year, there will be other expenditure pressures from the government, raising the twin deficit issue. So all in all, we are in for, in some sense, very interesting times. And it'll take all the expertise available in the Reserve Bank and the Indian Ministry of Finance. We have managed these things before.
Yes.
We have to make sure that we don't have the equivalent of a taper tantrum.
Okay, we have to make sure we don't go through a taper tantrum again, and that there is coordinated action between the government as well as the central bank. Sajid, since Dr. Mohan has said that you have all the numbers, so let me come to you then, Sajid. You know, what would you be most watchful of, and especially when it comes to the current account deficit vulnerability?
Shereen, thanks very much. So I think the point that Dr. Mohan made, I think I want to underscore, which is, you know, the collapse in oil prices has tended to kind of mask the widening of the underlying current account. If you strip away oil and gold from India's current account deficit, you actually get a current account surplus. But that surplus has reduced by almost 2.5% of GDP in the last 3 years. Right? So we've had a deterioration of the external imbalances by almost 3% of GDP in 3 years, which is very large. Now, I completely agree with Dr. Mohan that this has coincided with a 20% real appreciation of the currency between 2014 and 2018. And therefore, calibrated, orderly rupee depreciation is actually a good thing for the competitiveness of our economy. We've just done a lot of empirical work to show that the elasticity of India's exports to India's exchange rate movements is actually much higher than we thought, which is to say, number one, that most of the export slowdown in the last few years can be explained by a strengthening currency, and the corollary is that the weakness in 2018 will actually help exports going forward. Now, to put these numbers in perspective, the currency appreciated 20% in real terms in 4 years. It's only given back 6% of that in the last 6 months. So maybe there's a little bit more work to do, but this needs to be orderly and gradual. I'll just make a couple of final points, Shereen. One is that, what you're seeing today is not India-specific, and we should not treat this as a India-specific phenomenon.
Right.
Emerging markets around the world have sold off for the last 4 months, for the last week on the back of what's happening in Turkey. It's not just Turkey. The sell-off began when global growth became very desynchronized. US economy grew at 4% last quarter. It's growing at 3.5% this quarter. And Europe is struggling to break 1.5% in the first half of the year. It's this desynchronization that has caused the dollar to strengthen. That in turn has caused the Chinese currency to weaken. So emerging markets like India are caught in this in the middle here, where the dollar is strengthening and the CNY is depreciating. Number two, I'll just make a final point. So I think we have to accept the fact that there's not very much one can do when you're faced with this global environment. You can use reserves to slow the pace of depreciation, but you can't ultimately change the end point. All you can do is focus on your macro fundamentals. Keep inflation under control, keep the fiscal under control, try and reduce the current account. Last point, let's not obsess about 70. I think a rupee-dollar bilateral rate doesn't have much meaning. Policymakers need to look at the trade-weighted rate. In the last 3 months, India's trade-weighted nominal exchange rate has been flat. So I think that's the right policy to follow. The Reserve Bank is following the policy where the rupee is moving in line with our trading partner currencies, and I think that is the optimal response to what you're seeing globally.
Okay, that's an important point that you make, that don't obsess with that number of 70 that's been flashing on screens through the day. But let me bring in Dr. Sen as well. Dr. Sen, would you agree with both Dr. Rakesh Mohan as well as Sajid that what we are seeing with the rupee is a welcome trend, but of course the depreciation needs to be calibrated and needs to be orderly, and that there isn't much that the Reserve Bank can do beyond that at this point in time? What would you be most concerned about today when it comes to the macros?
Well, I completely agree with them, and I'm glad that all economists seem to be coming together on this, because I think the thing we really need to worry about, that there is...
I was hoping that there'd be sparks flying in the studio and you wouldn't all agree with each other.
No, not on this. But what I would, in a sense, Sajid mentioned it, and I think I should reiterate it much strongly, is that the fact that, we are making such a song and dance about this depreciation, that you're actually spooking the market. It's not a good thing. And the big fear now is not what's happening to the rupee, as Rakesh and Sajid have said. It's a good thing. It should continue to happen, but in a calibrated manner. But don't spook the markets. That's number one. Number two, as I said, after having agreed with everything both of them have said, let me just add one dimension. And that dimension is the fact that there's also a trade war going on. Now,
yes.
In that context, what you really should expect to see going forward is that large economies like India are going to be the battleground for countries seeking alternative export avenues. And so what we should expect to see is that the dollar-denominated prices of our imports, oil is the only one I'll set aside, will probably start coming down, right? So in terms of the fears of the rupee depreciation leading to inflation, I think those fears are completely misplaced. So what you're going to see is a depreciating rupee and a corresponding reduction in dollar-denominated prices of a very, very wide range of imports. Now, that's an important consideration because if that happens, then the focus on exports becomes much more explicit.
Oh, absolutely. It certainly does. But let me pick up on the point that you made, Dr. Sen, on inflation, and let me also then take that conversation forward to include interest rates. There was a surprise, Dr. Mohan, when we saw the CPI print coming in at a 9-month low. But the fact of the matter is that uncertainty still prevails when it comes to inflation. While it has come as a relief for especially FII debt investors to see that inflation print, what's your own sense on the inflation trajectory as well as the possibility of the RBI holding forth on interest rates through FY19?
Well, Shereen, one thing I've studiously avoided ever since I left the Reserve Bank is to comment on RBI monetary policy. So I won't start now, but I will make a couple of comments. I think that that we need to understand a little better inflation dynamics and the interaction with monetary policy. Monetary policy has to be focused on the impact of what it does, not on inflation today, because monetary policy doesn't act instantaneously. The impact of monetary policy takes anything from 12 to 24 months to have an impact. And therefore, given RBI's targeting, I would imagine that they are much more focused on what they expect inflation to be 12 to 24 months from now. Also in that context, also I think, as was mentioned in the Reserve Bank's statement, that if you look at the inflation expectations as measured by the RBI Inflation Expectations Survey, they've been significantly higher than actual inflation, and therefore the Reserve Bank has to manage those expectations better by maintaining a policy that provides confidence to the economy. I would add a couple of more points to what Pranab said. That one thing that has not, I believe, been talked about enough is the relatively slow growth of manufacturing in the last 5 years or thereabouts. I do believe that that has a very significant correlation with the very high real appreciation of the rupee, and therefore I would hope that as long as we have a calibrated and and gradual depreciation, that one of the other side effects, both in terms of manufacturing for the domestic market as well for exports, would be good news for the manufacturing sector as a whole and for Indian GDP at the same time. So I think that also the issue of of dollar prices of imports coming down, that one hopes that there will be such a supply response. And to the extent that we are seeing relatively good results in the last quarter from all the company results that we are getting, that it does seem to be the case that the economy is looking up, and I would hope that that tendency gets reinforced by this exchange rate movement, as long as people do believe that this is going to continue to some extent in some kind of orderly manner. So I think overall, the key issue really is for the government, Reserve Bank, joint action to maintain confidence in their ability to manage the economy both externally and domestically by joint action. I'm emphasizing this because recent events, recent noises in a sense, have given some sense that the RBI and the Government of India have not been on the same page. It's very important now for them to be seen to be on the same page so that confidence is maintained in the economy. Are you talking specifically
about the way that... Are you talking specifically about the RBI circular on the 12th of February and the government's response by way of a special carve-out for the power sector? Are you talking about how the RBI and the government have sort of gone after each other when it comes to the governance of public sector banks? What specifically are you talking about when you say that in the recent past the government and the RBI don't seem to have been on the same page?
I think you spelled it out very well just now, Shereen.
Okay, so those specific issues then.
Well, not so specific. There has been, one hasn't had the sense, say, over the last 6-8 months, that the RBI and the government speak in the same voice. There's often jostling going on. That's not good for the management of the economy, and I think they have to make a special effort to be seen to be working together. And especially in these circumstances, when a number of external developments are taking place, and of course, what you mentioned earlier, the pressures on the fisc because of the coming elections. And I am glad, of course, that the finance minister, both Mr. Piyush Goyal as well as Mr. Jaitley, have been very firm in saying that we will keep to the fiscal deficit targets.
Okay, let me go back to Sajid on that. And Sajid, we talked about the vulnerability on the current account deficit, but let's also talk about the fiscal deficit. And while this government has maintained that it intends to follow the path of fiscal prudence and fiscal consolidation, we are headed into an election year. There is, of course, still no clarity on how much the MSP is going to cost. The Ayushman Bharat scheme, in my conversation with the CEO of the program, it's unlikely to be a significant hit. On balance, how much would you be concerned with the fiscal deficit, and what about the current deficit outlook as well, given what we are seeing on the trade front?
What's different about the fiscal deficit, in my view, is, it's a control variable. It's a policy variable. It's not something that's truly exogenous. So from that standpoint, intent really matters. And we've seen in the past few years, both with this government and the last few years of the previous regime, that when you are determined to stick to your target, you find a way to do so, even though the means sometimes may be suboptimal. I've been impressed by the fact that the budgeted deficit this year on the expenditure side is actually very austere. Expenditure to GDP is coming down by 0.2% of GDP. I think the vulnerability more, as you alluded to, is more on the revenue side, and largely on two areas. One is GST revenues, because we're not sure to what extent compliance will improve, and the second is on the disinvestment front. But I think more than ever before, it's very important that in this very fragile environment for emerging markets, that India seem to be placing a premium on macroeconomic stability, and the most obvious manifestation of that is to stick to the centre's fiscal deficit target no matter what it takes. The reason I'm saying is that, as you mentioned, the current account deficit will be helped hopefully by a weaker rupee in the last 6 months. But if oil is going to be at $75 a barrel, is going to be tracking close to 3% of GDP this year, between 75 and $80 billion, which to start will not be easy to finance. Now the worry is if the fiscal does slip and that puts pressure on bond yields, then that can precipitate more portfolio debt outflows of the kind we saw earlier this year, and then that significantly changes balance of payments dynamics and increases your gross financing requirements. So I think there is a very direct reason why policymakers should adhere to the fisc. The last thing I'll say, Shereen, is we've seen under the radar, state finances have been widening over the last 4 to 5 years, thereby undoing the centre's consolidation. But I'm very happy to hear that both finance ministers have categorically said that they will stick to this year's deficit target. And so I think that will go a long way in soothing any fears that investors may have.
So, Dr. Sen, let me then get wrap-up comments from each of you. The top 3 issues that you would be most concerned about as we wrap up our discussion here on the state of the economy on Independence Day.
Well, at the top, I think the domestic dangers are limited and fairly muted. But right at the top of my list is the increasing uncertainty in the global environment, the increasing belligerence of all the parties involved. That can have enormous consequences in terms of investor behavior. And, you can get the safe haven effect playing out even more strongly in the future. I mean, I would put that as my number 1 fear. I agree with Sajid. I don't think the fisc is really the worry, but I think we should be prepared very much for the fact that as we come closer to the elections and the electioneering itself begins, then as has happened in the past, an enormous amount of liquidity gets released into the system by political parties. So even if the government is behaving responsibly, you can have unexpected demand pressure that crops up because of election year spending by parties. The third thing that I think we need to be very, very careful about is that if the trade war really goes further and if dumping starts happening, there is going to be increasing pressure to become more and more protectionist. This government has already indicated that it has no real compunctions about going back on the duty reduction commitments. That can accelerate as pressures grow. That would be a retrograde step.
That would be a retrograde step, and that is a key concern. Pranab Sen, Dr. Rakesh Mohan and Sajid Chinoy, appreciate you joining us here on the state of the economy. External risks continue to be, what could give India cause for concern. Domestic dangers, as Dr. Sen pointed out, at this point in time, somewhat muted, and the depreciation in the rupee, a welcome move. But there must be joint coordinated action between the central bank and the government to ensure that the depreciation is calibrated and orderly. Appreciate you joining us here on the program. Dr. Mohan, I would request